Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome a special guest, and that is Neil from Mortgage Corp. So he is a long-time Nuggets News subscriber, someone that I talk to regularly about the property market, and that's why I've got him on today. I really want to get a feel for what's happening on the front lines, but also talk about the changes that have taken place as he's seen it over the recent decades, and the Royal Commission, and what's happening right now with the COVID stuff. So yeah, thanks for joining us, Neil.
Not a problem. Great to be here, Alex.
I guess, to start off with, do you want to maybe run us through the history of the housing market in Australia as you've seen it?
Yeah. Well, I mean, I don't think we've got enough time for that, but probably about 17 years ago, I qualified to become a mortgage broker and got started in that. And it's been a pretty epic ride with the ups and downs and the Royal Commissions and the global financial crisis and ninja loans, housing prices, where we've gone from the old pitch of housing's prices double every 10 years. You can forget that now. That's gone out the door. But yeah, historically we've seen a massive amount of capital growth on a lot of property in the last 15 to 20 years, especially in and around the major capital cities, Melbourne, Sydney, obviously. Where unfortunately though, now in a lot of other capital cities, we're starting to see property values going into negative equity in some places around WA and Queensland, northern Queensland. So interesting times.
And I guess we often say the property market, but it is a tale of so many different stories. And I'm chatting to people in Tasmania, and they're saying that some aspects are bad, and then they've got baby boomers wanting to retire here. So that's always important to keep in mind today whenever we talk about anything, isn't it?
Yeah, and Tasmania was the tip of the tongue over the last 2 years when it came to property investors, and obviously a lot of overseas investors that came into Tasmania and started snapping everything up because Melbourne and Sydney have got hot, and your Glen Waverleys of Melbourne and your inner cities around inner suburbs around Sydney getting hot, bidding because they didn't want that person to buy it, not because of market value. It was nuts.
Yeah, so I guess the really brief overview of the way I see the housing market, and we did a documentary on the Australian economy and how it all works and why I think things are probably going to be tougher ahead because of those structural headwinds. But we've been a very lucky economy, the lucky country. We went 30 years without a recession. Interest rates have just gone down from 17, 18% to now zero. We went from that sort of the dad works in an Aussie family and maybe mum raises the kids a generation or two ago to we've got two people on full-time incomes. So everything's just sort of been this huge tailwind that's just pushed up house prices. But now I think we're reaching the limits of that to some extent.
Yeah, you're right. And I mean, how many times I've interviewed first home buyers, and there's a lot of family pledges that have been going on. The mums and dads, the baby boomers, have seen massive capital growth where they bought a house for $16,000, back in the 80s or 70s and 80s, and they were working two jobs. And back in 89 and 92, it was 18%, and you guys have got it lucky. It's 3%, 2.5%, whatever it is. It's like you guys have got it lucky, and obviously the relative to dollar, they don't understand the fact that the income levels are a lot higher. They were earning $100 a week. So to where we are now, where we've got debt to income ratios, and we're using household expenditure measures to assess loans, and we've got assessment rates, and where it's all going to go to. Yeah, interesting times ahead for sure.
And do you keep an eye much on other countries where it's more common to rent, and we look at the percent of income that's going to someone's mortgage in Australia? In a lot of other countries, that's lower. Do you sort of cognizant of all that stuff?
To be truthful, not really, Alex. It's really hard because at my level as a consumer finance person, when it comes to mortgage broking, you're dealing on a day-to-day transactional point of view. You're dealing with the credit policies are dramatic at the moment. There's changes ongoing. So to see what's going on overseas, it's really hard. But to understand the density change that we have, where it went to the apartment market, to the grass, having a grass yard at the front, white picket fence, two kids and a dog. I just don't have the dog, but seeing that shift and change in Australia. But now with what's going on now, we might see it go back the other way again, working from home, working in Ballarat, and, when your office was in Melbourne. So we don't know. There's a lot of things. But when it comes to overseas, I don't have the capacity to measure that stuff.
Yeah, and it's probably, I guess it's not relevant to some degree, whereas in investing or other things we talk about, it's very relevant to what's going on. Whereas in Australia, and we talk about sentiment, it doesn't really matter what other people think you should pay for a house or what other percentage of wages are, and that it's very relevant to Australia or their local town.
That's right. And the funny thing is that, here in Australia, our banks are a lot different to the world banks. I mean, we've got banks making $4-5 billion profit on a population of 25 million people. Yet, when we look at the bank ranking in the world, with some of the European banks, their rankings and their turnover and their profit that they're making compared to what we're making, there's something missing there.
Absolutely. And just quickly, I mean, why is that?
But that's a good thing. That's a really good thing from my point of view. Is it offers lending security. So when you are buying a house and you're borrowing from a bank, the big question is what happens if the bank falls over, which is what happened back in the old Adelaide when the triangle banks and all these sort of things that were going on back in the early 90s and late 90s. It was like, the question from the mum and dads are, what happens if the bank falls over? Well, have a look at the profit reports.
Yeah. So when you say it's a good thing, you're referring to bank security, not necessarily
bank security, not profits.
Yeah. Not the cheapest mortgage out there for the individual, because the credit card interest rates and the mortgage differences. That's why banks are
and the margin lending, the margin loans, the business lending, borrowing at BBSY plus and then line fees and all of that from a commercial perspective. Because we've got to remember in Australia we've got two types of lending. We've got regulated lending and unregulated lending. So under my side of it, where 99% of my business is, it's regulated lending. And that's covered by the National Consumer Credit Protection, where, we have a lot of compliance that fits around that as a broker, especially.
Do you want to maybe talk about how that changed over the years? And as you said, we used to have, the days of like state banks or national banks and how that's changed, and what you can do without any, I guess, qualifications in terms of broking and the regulated, non-regulated. Do you just talk about sort of how that all...
So, when I got into broking, it was basically having an interview with a lender, going through their, do's and don'ts, and here's a book of all our policies, and go away and read this, and running through with relationships with each bank and building that over time to find out what was their appetite. And as technology's evolved, we're able to sense which lenders have an appetite for what. Are they turning off their investment lending? Are they looking for first home buyers? Are they looking for more equity level? And the technology is enabled to do this. So back in the old days, becoming a mortgage broker was a matter of doing a few meetings and qualifying, that you understood the basics of LVRs, LMI, loan to value ratios, lenders mortgage insurance. But nowadays, and obviously I've been keeping up with that because as a qualified mentor, which was brought out by the MFAA, Mortgage Finance Association Australia, they brought out a mentor program where we had to sit do a course, become qualified as a mentor. I've got a diploma, and now you've got to have a minimum certificate 4. Some lenders will accept it, some won't. One of the majors specifically won't let you become accredited without at least 2 years experience. Yeah. So definitely a big shift and a big change from what it used to be to what it is now.
Yeah.
For the positive for sure.
Yeah. So what are the horror stories, or do you see it in the movies where you have the guys that are just trying to get everyone onto these mortgages and they get a kickback, and we heard stories of, gym instructors getting that kickback. So what's regulated and what's not in Australia presently?
I say, so commercial lending is not regulated per se as covered by the Consumer Credit Code. So anything to do with buying a commercial property, doing development finance, asset finance to a certain degree under company. So anything you can associate a legal company entity to a transaction becomes non-regulated. And I'll go back to that in a minute, because of very interesting things happening at the moment, which we can go on. But on the regulated space, it's your car loans, your personal loans, your home loans, investment loans, all that sort of stuff being regulated. And there's been a real tightening of compliance as a mortgage broker. I'd say 90% of my work is compliance.
Okay. And when did that start? Was that post-Royal Commission or was that earlier?
That was way before the Royal Commission. And I call the Royal Commission a squirrel effect when it comes to mortgage broking. I think definitely it was called for to have the Royal Commission, and it pointed out a few flaws, but not all the flaws. especially with the subculture within banking branches and banking having to hit targets and financial planning. I have quite a few friends that are in that space, and obviously the conversation that they would have with a client would be completely different to the conversation I would have as a mortgage broker with the client's best interests. But yeah, interesting to see where that Royal Commission, we were already as a broker putting those compliance measures in place, such as living expenses, verifying income, affordability, loan options, repayments, all of those were being covered well before the Royal Commission.
But are there brokers that didn't have the client's best interest at heart and were getting kickbacks from the banks?
Yeah, so that's an interesting thing. So back in the old days of ninja loans, so pre-GFC, the no income junk asset loans, the ones that got packed, stacked and sold off and caused the GFC, they were like, refer here, refer there. Some brokers in the old days just had a phone number where they would ring the phone number and then they would send it off to a bank and they'd get a clip off the ticket. We've seen since the Royal Commission changes where real estate agents and accountants would flick business off to local business bankers and get commissions. In my honest opinion, it's not for the benefit of the client. It was always to the benefit of the referrer, because you're not giving your client those options. There were, gym instructors referring to local banks, but a lot of those have now changed since the Royal Commission, and to the better.
I think one of the things you said in the pre-interview was a lot of the Royal Commission, or maybe just the media, was concentrated on the brokers, whereas a lot of the problem was probably more the banks. And I know the Royal Commission didn't get as much time as it probably needed for the magnitude of what was going on.
That's right. I've got to agree. The main things that needed focus didn't get the focus that it needed. And when it came to the mortgage and broking side of it, because we're an independent business, and we have a lot of associations and groups that we try to be part of to help on the lobbying side of things, when it came to knocking on doors and saying, hey, we are here 20,000 strong and we're here to look after the client's needs. And this is where it formed AFCA. So the Australian Financial Complaints, it used to be the Ombudsman, the Credit Industry Ombudsman, now called AFCA. They're seeing less than 1% of complaints coming from the mortgage broking side. So, it really does point out that the squirrel effect was, really in play when it came to the mortgage broking from a media perspective, in my opinion.
Yeah, okay. Let's maybe go back to other things that you've seen change over that time. So when did things like negative gearing, first home owner, first home builder, when did all that sort of come into it, and how's the sentiment of the client that you see rock up? How's that changed over that decades?
Yeah, so it used to be, before I started, it was all 20% deposit, know your bank manager, your wages, you walked in with the yellow packet of pay, you put it in, you said g'day, and it was like, hey, I need a credit card, let's have a chat, all that. But that was way before my time. Then we had, when I first got into the industry, was when we started to see a lot of the ninja loans. So the low deposit schemes, the 105% finance, buy a house with 105%. There was banks offering loans where you could borrow 95% plus 7% mortgage insurance, which is still around, but they were offering credit cards at home loan rates to match the difference, so you didn't need a deposit as long as you serviced that. So that was a real interesting time where people could go and borrow a lot of money, and we saw what happened there, right?
Yeah, and I'm just trying to, for people that maybe aren't in the property game, I'm trying to think of a good analogy, and it's almost like if you're going to trade shares or cryptocurrency, sort of jumping into the market and opening a trading account and an exchange, and them giving you leverage and saying, it's all good, we'll even pay for your fees, and we'll give you a hardware wallet to store your crypto, and you've got so much exposure, more than any money you had, and as long as everything goes up, it all works out great. And that's basically what happened, where property just kept going up. So it didn't matter if you were leveraged over 100% by the time you pay for all the other costs, because everything just kept going up.
And I think it was probably around 2008, 2009, we saw interest rates at the highest in the last 20 years, 8.5% or 7.5%. You know what I mean? What are we talking now, Alex? I mean, we're doing home loans at 2.19. We've got RBA at 0.25. And when the ninja loans were so high, the profits were great, and ninja loans were at 9%, and low docs and no docs. I mean, there's still a variety of those floating around, for the right type of clients. Not something that we try to get involved in. But the no docs and low docs were massive.
And what do those stand for?
So they were like no document home loans for self-employed. So if you had a business, you had an ABN, and I've been trading for 2 years and I make 80,000 a year, and you're like, okay, is that all? And have you got any evidence of that? No. Well, then there's a low doc over here. You just come up with 40 grand and you can buy a house.
Yeah. And for people who have been going on this financial education journey with us on the channel, they're starting to piece all of these pieces together where they hear about interest rates and spreads on bonds or junk bonds. Yep. And it's the same in the property market, mortgage world. Yep. If someone comes in that's super risky and no documents, maybe you give them a mortgage, but it's 9%. It's that higher.
And that's where we're seeing now. We're seeing a lot of small, medium enterprises who are struggling to get money from the big banks is being scooped up by a lot of these non-coded lenders under the unregulated side. They're getting all the baby boomers' money and offering 6, 7, 8% returns by lending no doc on an asset lend of 60%. And we're seeing a lot of that at the moment, Alex, and it's quite frightening because they're not getting the right advice and they're risking their money on commercial property at the moment where we don't know where it's going to go.
Yeah, and I do definitely want to get to what's happened now with COVID and where you see things going in just a second. But I guess, is there anything else that you wanted to touch on just in terms of investor sentiment and people coming in and wanting to maybe have one investment property they'd rent out? These days, it's very common for people to have a big portfolio, or you hear these super investors with 100, 200, or Airbnb super hosts with 20 properties. Has that all only been a recent decade phenomenon?
Yeah, definitely. So Airbnb is a very interesting thing. We've seen a lot of marketing, social media marketing back in the last 2 or 3 years where you can, sub-rent other people's properties and then lease that out through an Airbnb system. And then you would pay the owner $600 a week, which was, a small percentage above what they would normally get, and then you would go and lease it all out. And there were businesses built on that in the last couple of years. I don't think I'm going to hear about them anymore for a while.
Was that something that was encouraged or run by Airbnb? Like, could you?
I don't know. Okay. I saw a lot of it on social media, Alex. I saw a lot of these ads, like come to these seminars, learn how we have 50 properties under management under Airbnb, and we don't have to buy the property, like no stamp duty, all that sort of stuff. And that was a lot of vendor financing going on as well, which is really scary as well.
Yeah, Ben and I went to one 6 months, a year ago, just to see what it would be like. And it was one where they were telling you that with a big enough credit card sort of thing, you could get started on your journey, use that credit card for a deposit, rent that out, Airbnb it, flip that, take the equity out and start building this big portfolio. And I just remember clearly that there was a couple that won Investors of the Year or Property Investors of the Year. I'm actually pretty sure it was actually like Australian Investors of the Year. And the following year, they'd gone broke because all the properties that they were fully leveraged up on had turned and gone down 10%. But that's just that totally sort of, I guess, personified what happens in Australia, the way that we glorify property investing.
Exactly. Well, I specialize in property investing. So going from when I first started nearly 20 years ago, that period of learning and earning, I've still got clients from back then who bought their first house, and I'm now doing loans for their kids, right? So I feel old, right? But the interesting story is that where I've seen a lot of development is like, so for example, in Melbourne, we've got Far West and Werribee, for example, where clients were buying houses for like, less than $300,000 for a land and house package or whatever. Now those are worth $600,000, so there hasn't been that doubling, but they're using that equity to then leverage into other properties. And from our point of view, especially my point of view, it's really important to put buffers in place. Don't spread yourself so much. Make sure you've got the cash in the bank. The 10 property investors, you get half those people not paying rent and you're going to hurt.
And that's what we're kind of seeing at the moment. So,
exactly.
Yeah, I mean, I actually don't like to try and talk down property and always seem doom and gloom and make it seem bad, because I definitely think that it is something that you can really positively invest in. And like I said, in Tasmania, I've got more than one property, for example, but it's very different to going and buying a 800 grand off the plan, apartment in Sydney.
And the property is my store of value, Alex, at the moment. And obviously Bitcoin may be yours and other cryptocurrencies, and I really enjoy watching a lot of your information about that stuff. But property is my store of value because touch, taste, the old adage of that, but also buying within your means is a real big issue with me as well. So not buying, the bank might lend you $1 million. Don't go borrow $1 million. Just because they lend it to you doesn't mean you need to take it.
Yeah.
And being risk adverse when it comes to spreading and watching out for tax when it comes to land taxes in Victoria. A lot of people aren't aware of the implications of rates and costs and maintenance and all of that when it comes into it. So taking a small bite, but with the way property is going to go, we have a lot of seagulls flying around at the moment. I'm doing a lot of pre-approvals. We're getting a lot of investors getting ready. Ready for what? Well, you're probably more aware of that than what I am. I've just watched your video with a few of the guys that you've done recently, and it's like the milkshake theory and the oil industry and the US dollar. So where it's going and where I see it going at the moment with the COVID is that the JobKeeper program is going to take us till September. Are those businesses still going to be here after September? What's going to happen with all the industry super funds that have invested into commercial? Where is all this going to play out in the next 12 months? It's not happening today, but where's it going to play further?
Yeah, so as we get into talking about what is going to happen from the next few months and possibly years, do you want to maybe talk about the realistic return? So the best case scenario, we hear about this property doubles every 7 or 10 years, and we hear about these yields in Tassie, for example, you might still be able to get 5-6%, other places a lot lower. What do you think some of the misconceptions are when we hear about these people that are flipping that house, doing up the reno, and they hear the bought for, sold for number, but the stamp duties and the other costs, ongoing maintenance?
Well, I mean, in Victoria,
some realistic sort of numbers and what people are getting.
All right.
Yeah.
So in Victoria, on a $600,000 house, you'd pay probably nearly 30 grand, right? Straight to Dan Andrews. Thank you very much. There's a bit of revenue for your expenditure. So, and not having a lot of property sales is going to hurt as well. So then the other side is the cost, the agent's cost. So whether you get $350 a week, you've got to take out the 7% agent's cost. You've got obviously land tax. You've got rates, maintenance costs, all those little things. But we still see the flippers, right? Which are your tradies. So, your tradies are going to come in, they're going to buy a house, they're going to do it up, they're going to flip it, and they're going to make some good money. And I've got a lot of clients that do that, and they're very good at that as well.
Yes.
But then there's the mum and dad teachers and the accountant who are trying to do a flip, but they're using the tradie and they're paying premium for the labor and the cost.
Yeah.
And unless you buy the right house at the right price, you're not going to make as much money. So there's a lot of research that goes into finding those, the worst house on the best street scenario, where you can spend a bit of money and get a bit of return. The two reasons you want to buy property is mainly for yield and capital growth. Yeah. Finding the magic mix is that's the thing that we spend all our time looking for, nearly 20 years looking for those magic mixes. And you're right, in Tasmania, you can get good yields, 5%, 6%. Because of the cost of the property and the lack of property down there that's available for renting. But even the same in Victoria, you can do in Albury and Wodonga, you can still get those rental yields, but you won't get any capital growth.
Yeah.
Unless you hold that for like the next 15 years, you might see a slight capital growth.
Yeah. So I do just want to explain that in a very basic manner for people at home, because it's probably a good opportunity to explain negative gearing as well. So when we talk about these yields, again, this is why I love that people are hopefully watching all the videos about bonds and crypto and everything, because it all intertwines. So when we say that you might be buying this house in Tassie, somewhere near the uni, and you're renting it out, and let's just say it's $100 a week to use a round number, but you're charging $105 a week. So on paper, that is what we're referring to as a 5% yield. So you're actually getting that profit. But we're also hoping that the house goes up in value, and that is our growth, our capital growth. And as an, do you want to maybe talk about how the tax works with the negative gearing if you don't get enough rent?
So I'll put a disclaimer here. I'm not an accountant.
Okay.
So, but I can tell you how negative gearing works from a servicing and a borrowing capacity. So your negative gearing is offset against your income. So if you're getting $5 on an investment property, but it's costing you $4 in interest, then the $1 you earn is applied to your income, and you pay tax on that, on your tax rate. Okay. But your accountant's job is to minimize all of that by looking at things like depreciation and costs and so forth.
Yeah.
And they've changed that up a bit as well, with the way that you can not depreciate anymore on, new, unless it's a new property. So all of that. But the negative gearing from a servicing point of view is a real tricky thing, because a lot of banks look at it differently. So when it comes to negative gearing, and rental income especially, and in the last couple of weeks, we've seen a lot of the banks slash the amount of rental income they'll use towards servicing your ability to borrow money, which in turn, with the negative gearing aspect of it, will decrease your ability to borrow more money. Yeah, especially if you're a heavy investor, that's going to hurt a lot of people hard when it comes to them wanting to refinance from, a fixed rate where they thought they were fixed at 4.5% and it was great, but now they're going, well, hang on, there's investor loans for 2.59%.
Yeah. I guess, so just before we dive into some of this other more complicated stuff, just to really simplify it, in a nutshell, if you're not getting enough rent to cover the cost of the property, the mortgage, that's when you can start to negative.
That's when you can negative gear. So when you're getting $5 in rent, but it's costing you $7 in interest.
Yes,
yeah?
And you can take that off your taxable income.
That's correct. And then you take that off your taxable, whereas the other way is positively geared. Ideally finding, and when I talk about investment strategies with my clients, we try to find a good balance, whether it's, one person buying a $700,000 property or going out and buying two $350,000 properties with the chance of one of those giving you a bit of capital growth, but both of them offering strong yield as well.
Yes. Yep. So what I did want to get into now is a lot of those changes, because as I say, I think capital growth is probably not going to have the same. It was really big, wasn't it? You're just not going to get that doubling every 10 years. Well, we're not getting wage growth. I just don't see how that can happen.
No, and I've got some stats for you. So I've got some, and here's a funny thing, I had some property here in Melbourne, and I've gone back and looked at the data on those over the last, couple of days. And one of the properties in 2004 was worth 264 grand. That's what it sold for, not what it was estimated. That's what it sold for. In 2014, so 10 years later, that same property sold for 551,000. Okay. In 2020, so 4 weeks ago, that property sold for 765,000. All right. So there are pockets where you will get some increased capital growth, but then I've got another pocket of properties that have gone backwards. Yeah. So, you've paid 500 for it in the last 6 years. It's worth 480,000. So you've got to be careful on that side of it. And that's negative equity territory, where it's somewhere where you don't want to be.
Yes, when your loan is bigger than the property's value because it's gone down. So that's something that we're starting to see pockets of, and Martin North talks about his heat maps and that kind of thing. But what's the big changes that we're hearing about from the banks after the COVID? And it's that assessment rate where they might say, well, yes, you're getting that rent, but we're only going to do our calculations with 70 or 80% of that, because we've got to factor in the chance that it might be vacant 20% of the time, or you might have 20% less customers if you're a business. So all the sort of, it is a bit of a house of cards, because once you start decreasing that, it has flow-on effects for everything else, doesn't it?
Yeah, and I've been making little notes while I'm talking to you, because there are some points that I want to cover off.
You go for it.
Yeah. So assessment rates, really important to understand what an assessment rate is first. So when I'm sitting with a client and we're doing our strategy sessions, which I do with all my clients, either like this or face-to-face in our boardroom when it's allowed, is talking about that an assessment rate is a rate that a bank will use to assess how much they will lend you, not the rate on offer. So even though we might have one of the banks who may be a color orange, for example, offering some really good products in the market, and people ring up and say, I want this orange product, funny enough, and we do their loan assessment. We say, you can't afford it. And the reason why is that a lot of the banks have changed their assessment rate, and it was a lot of pushing up until a point where it used to sit at 7.5%. When we saw interest rates coming down from 8.5%, 6.5%, 7.5%, going down, it started going further to 5%, 4.5%, but the banks had their assessment rates at 7.5%. So how much money you could borrow was determined by if you could borrow the money at 7.5%. One of those banks kept it at 8%. Now, since then, the recent changes are they've put other buffers on top of that. So they're saying, we'll assess your rates right now roughly around 5.5%. So if you can borrow money at 5.5%, we'll lend you this amount of money. Whereas one of those banks has actually just left it at 8%. So even though they're offering a really good deal, you may not be able to borrow as much because they're after we want the strong clients. We want to have a strong book going forward. So assessment rates are different. When it comes to rent, so in the last 3 or 4 weeks, a lot of the big policy changes are where a bank will say take 80% of the rent that you're receiving. So for every $100 you're getting, they're taking $80 to use towards your income. But then they're also behind the scenes applying another buffer and assessing that at 80%. Okay, so we're down to 60% of your original income that we're using to borrow money. I mean, it's a good thing and a bad thing on both sides. If you're a strong applicant, then it's fine. If it's not, then maybe you should reconsider when it comes to borrowing money.
So I guess for people at home, the way to think about that is not only are they saying that there's a risk there in terms of the rent you might get, there's a risk that the property might go down in value, and there's a risk that you might lose your job. So they've kind of got to factor in all these layers that might go down 20%, for example. Yeah,
and 20% is an interesting number because we're seeing a lot of industries where people's wages have been cut by 20%. Some of the top end of town, we've seen recently on some of our financial review magazines and updates where they've agreed to 20% reductions. And they've got to be catered for, but they're getting a letter from their employer saying, we promise by September that we'll add that 20% back to your income, and that's a promise you're going to have to wait. So specific industries are being targeted as well. So essential services, very strong, overtime-based stuff, shift allowances and all of that is a good thing. But when you've come down to your car salesman and your real estate agent and your IT professional who's on performance bonuses as well, they're going to get shaded very heavily when it comes to assessing income on that basis. The JobKeeper is an important thing. So some of the banks have said, no, if you're on JobKeeper, don't come to us. But even as recently as yesterday, one of the big four have come out and said, you know what, we'll use the JobKeeper, but we're going to use the JobKeeper income as an assessment, not what you were on before. So,
And it is tough for banks, isn't it? Because as you say, they are in this position where the central bank has printed a lot of money in some cases and given them reserves, and they're saying, lend, we want you to lend. But the banks are kind of in this defensive mode, and this is happening in all countries to different degrees, but they're trying to raise their reserves and they're battening down the hatches for failures and for a recession, maybe a depression, they don't know yet. So even when you or I walk in, they say, yeah, you're on this JobKeeper, but are you going to get back the same job in 6 months' time?
Well, is the business going to be there in 6 months?
There's all these unknowns.
Are the industries? I mean, when it comes to assessing someone's income, I mean, we're going through their personal bank accounts and we're looking for afterpays. We're looking for other large lump one-off payments that we have to show the bank that, are these irregular payments? And is this the person just doing a reno on their garden shed every month? So scrutiny of applications of loans is, it's the highest I've ever seen. And I'm all for it. And I have built my business around compliance, and that's taken our business very, very, very well up into the upper echelons of being where we are as a broker.
And what are some of the numbers you've seen here? Because we hear that it's very hard. Some of the other ones we haven't maybe touched on are, self-employed people. So in terms of the number of people that are coming in, the amount that people were maybe allowed to borrow. So how are all these numbers now, do you think, going to reflect on the other side of this 6 months' time? Do you think property goes down 5%, 10%? Do you think it stays sideways?
I'm going to agree with you on the 10% side somewhere. But I mean, take it, for example, every bank is risk averse in their own way based on what they've got in the bank. So one of the big four has slashed how they assess self-employed people, full stop. So if your loan's above 80%, you're self-employed, don't even go to this bank. All right, they're not going to look at it. So, and that's their appetite. So finding a good mortgage broker is key in this case. And we're able to understand the bank's appetite. So are the banks still lending money? Yes, they are. And they need to, and they want to, and they just need to tick all the little boxes to evidence the fact that after the Royal Commission, I've asked these questions. Can you afford this? Are your living expenses well explained? why are you telling me that your living expenses are only $1,000 a month, but you're spending $500 a month on shopping? So where's the rest of it going? And these are the things we need to cover off. So from a lending perspective, the banks want to lend money. They just want to lend money smarter and less risk when it comes to that. So self-employed people need to provide, this is really interesting, so the last 90 days bank statements to show that they've got invoices are being paid or money's going through the business on that side of it. Some banks are actually ringing clients 14 days before settlement to say, have you still got a job? Because they've been pre-approved in February, March. They bought the house. We're coming up to a 90-day settlement now, Alex. And a lot of these banks, I'm getting clients ringing me saying, such and such just rang me to see if I'm still working. My settlement's on Friday. I mean, come on. So there's a lot of that's been put into place. And what we're seeing, a really interesting thing, Alex, is where a lot of the offshoring of bank processing in India, Philippines, as soon as the COVID came in, some of these big banks acted fast, some of them not so fast. And we're seeing, like, I can get a loan processed properly within 24 hours. But if I go to one of these other banks that may have pulled offshore, I submitted a loan in April, they're not going to look at it until June. So how does the client going to look at that?
Is that because they're doing a lot lower volume and they have the ability to do that as well?
No, there's cashbacks are a killer out there. So a lot of the banks are trying to buy business, or especially in that January, February, March, and April, we had a lot of banks offering cashbacks. NAB and Westpac were offering $4,000. Some of the banks were offering cashback per property. So one of our clients was fortunate, one of my heavy investors had 14 properties and was able to invest and get a large kickback or cashback, you could say, on his refinance for bringing all his properties over. So that put a lot of pressure on the workload that these lenders were doing to try and process the loans, now onshore, not offshore.
Yeah,
and that's what we're seeing now with one of the other big four who've also got a cashback offer. Your loan won't get looked at for 30 days. And I mean, as long as it's a refinance, you're fine. But if you're looking to buy a house, forget it.
Yeah, okay. Anything else that you're noticing from the front lines in terms of appetite, trends, things that have changed from pre-Royal Commission or pre-COVID? What's really important for people at home to know?
I think it's really important that they do their research. And number one, find a good broker. Yes, I am a mortgage broker, but no, the broker's side of it is so important to the relationship with the financial institutions now that over 50% of home loans are introduced by a mortgage broker. You're not going to get an any worse a deal. There's no extra cost. And this has been highlighted many times. It's just like a bank having a branch. So before the Royal Commission, we were doing all the compliance stuff. We were spending a lot more time on compliance. Now we're ramping it up even further, which was introduced before the Royal Commission. That the trends we're going to start to see, definitely, you said frontline. So frontline workers, teachers, nurses, doctors, they've all got jobs. So their incomes are good and they can pretty much have a look at a lot of good opportunities to either refinance, buy a house. Their job security is a big thing.
Yeah.
Building industry, whole nother aspect. So as long as you're a good tradie and you've got good books and you haven't been doing a lot of cashies, you're going to be able to borrow money as well, as long as you can prove and evidence that, not just off the basis of hearsay, but show the paperwork.
Yeah.
Investors, we're going to start to see a lot of investors. So there's going to be a lot of mum and dad investors now getting ready and getting prepared for whatever it is that people like yourself and all these other people that understand the economics that's going on behind the scenes may be getting ready for. Is that time today? Well, some people are saying yes. Others are saying let's wait 6 to 12 months. So doing a lot of pre-inquiries, pre-assessment and strategy sessions, showing people how do you get access to equity? What steps do you need to put in place? And secondly, do you really want to get involved in this space?
Yeah.
If on the flip side, your tenants are the ones that are affected, So first home buyers, active, very active. Your sub 700 property prices, we're seeing a lot of first home buyers, and they are teachers, nurses, on that side who know that their jobs are secure and they've been able to save the money.
Yeah, I guess we do see a lot of maybe baby boomers downsizing and they want to get rid of one or two properties and just have the best principal place of residence for tax purposes. So there's a few changes happening, I think, in the market. Have you noticed, overseas investors returning, or are they staying away, anything like that?
They did a bit of damage to the overseas buyers, and when we saw what happened back in the last 4 to 5 years, where we had a lot of property spruikers, and the spruikers were coming out of the woodwork, flogging apartments to overseas, specifically Chinese buyers.
Yeah.
And I was quite a big advocate of the fact that I didn't want to get involved in that space in many ways, have lost their deposits. The valuations have fallen short. But we saw the FIRB, the Financial Investment Review Board, their approval ratings were through the roof prior to a lot of these property booms that we saw back in the last 3 to 5 years. And that was a big influence, was the overseas buyers. The fact that they increased the stamp duty, nobody likes giving away money to the government, no. and made it a lot harder for them to borrow money. So one of the interesting factors that led to a lot of this collapse from the overseas market was there was a lot of fraud going on, where a couple of the banks, I won't say who, had found that there were loans being approved for overseas borrowers who weren't earning money that they say they were going to earn. Now, those type of borrowers weren't intentively the type of borrower that was going to default, but it was found that they were fraudulent loans. And we're talking over $500 million with one lender alone, who found that all these loans were fraudulent. The pay slips were wrong. And that's when they turned around, and all of a sudden you had one major say, yep, no more overseas borrowers. And then everybody jumped to the next bank, and then that bank's going, well, hang on a sec, we're not ready for this. We're not going to do overseas either.
Yeah.
And that's when we saw those properties and people losing deposits and values and stuff. So
yeah, we covered that in the documentary as well in Australia. There's an international report that got done, and Australia scored 10 out of 10 in terms of every different category they looked at. Australia was the worst for fraud in the Australian property market. Yeah.
Yeah, but now that's a very big point, where the banks have got systems in place now, data scanning, matching. We've got the live reporting system now, where I can go on and do live report. I can see how your loan repayments have been. We've got the ability for banks to now talking to each other. Literally, a bank will pick up a phone and ring the other bank and say, this is what we're doing. This doesn't look right. Yep, if it is, it is. Okay, thank you very much. And the paperwork that we've got to do, and the reasonable inquiries that we as a broker have to make, we don't get a lot of those that type of business, because the amount of information that I'm asking for is more than what the banks are asking for.
Yeah.
And they're like, well, I wasn't prepared for this. I got told I only have to provide, 90 days worth of pay slips. And I said, yeah, but I need to see that the last 6 months have been consistent. Right. And they're like, well, I haven't got that. And I'm like, well, then we can't help you. So, the banks, that's where a lot of banks fell out, because they weren't making those further inquiries.
Yeah. Awesome. The final thing I guess I wanted to touch on was commercial real estate. So working from home, we've already seen Twitter tell their staff that they can all work from home forever. A lot of people, I guess it was kind of like a bit of a San Francisco-y thing, or Wall Street, where everyone wants to move to the big city, work in these high rises, and live the startup life. But I think it's definitely changing.
It is. And I mean, in my business alone, we were fortunate enough to be pretty tech savvy. So, it was literally pick up the phone, which was our unit, and take it home, plug it in. And now it's like working from home, and it's using the same phone system. The software we have is available to be used anywhere. And a lot of the big banks, because obviously I'm in the industry, had the ability to do that, or acted very fast, Alex.
Yeah.
Where we had ANZ and the team of guys at ANZ, they knew they had issues. They were onto it straight away. And then now, I think I spoke to somebody there, they were saying they were looking at rotating 30% of their staff to work from home. So all these big buildings that the banks, have, aren't going to have the tenants in there. And I mean, we're even seeing small to medium businesses where one person was doing, a specific amount of tasks, but because they had to go home and work from home, they're now broadened their task, the ability to do more tasks. And they're like, do I need these extra staff? So I have a funny feeling the middle management's in for a shake-up when it comes to it. So instead of a company having 6 floors in Collins Street, I think we're going to see that coming back to 2 or 3 floors. So what does that mean for the other 3 floors?
And that's, again, it goes back to the owners of those properties. maybe something we haven't touched on yet is the deferrals. So whether it's the tenants or the landlords, the building owner, if they've paid off their debt already, how does that all work from what you're seeing? What are you hearing?
All right, so commercial or residential, Alex?
Oh, a bit of both, yeah.
Okay, so the commercial side of it, it's a whole different ballgame. You got to negotiate with your landlord and, put the sob story in, go from there, see what happens. I mean, we've got Solomon Lew over here. We all know he owns Smiggles and stuff. And he turned around and said, I'm not paying any rent. Screw you guys, I'm going home. And that was it. And who's going to argue with Solomon Lew? What are they going to do? The amount of retail outlets that these people have and who own these retail outlets. We'll get into that a bit later, obviously. But on the residential deferral side, so that's a really good thing what the banks have done. The play that's going to come out, which we'll see in September, will be what happens to that interest. Some banks have deferred it and added it on to the end of the loan. Some banks will actually go into negotiation with the loan, the borrower, to say, hey, did you want to make extra payments and catch up? Yeah. So, how are you going to afford that when that comes to play, especially a lot of the second tier lenders or third tier lenders who are balance sheet lending, Alex? I mean, they don't have the ability to go and drop all their rates because they bought it, at that time for a certain amount. That there's not a lot of room for them to play when it comes to the deferral side.
Yeah.
With the tenant side of it, though, so if you've got a tenant who's not paying rent, you've got to go back to your bank and say, my tenant's not paying rent. How do I defer this? But you've also got to look at the consequences of what's going to happen out of that deferral.
And in America, we've been talking about this corporate bond market and the junk bonds getting downgraded and that cash flow because of these sort of reasons. In Australia, it's a little bit different where we don't have a big corporate or junk bond market. It's more often just the banks or the super funds that have all this exposure. And to me, Australia is in this situation where they have to try and keep property up, because if property goes down, it's just this flow-on effect to the banks, to the super funds, to construction, which is the biggest industry, and it all just flows on together.
You're right. And I think I've mentioned to you before about how the Master Builders Association have come out. The CEO, she's come out and said, 40% drop in expected business over the next 3 to 6 months, for the fact that, building contracts are going to go down. I mean, people who are on JobKeeper are not going to go buy a land and house package. So they've gone to CBUS, and then CBUS are heavily invested in, industrial and commercial property. And who runs those commercial industrial properties? Your retail outlets, your land leases, your Westfields, your all of that sort of stuff for these big businesses that are out there. They're going to try and get liquidity because your mum and dads are going, well, I want my 10 grand. And then when you've got 1 million people knocking on the door saying they want their 20 grand after July the 1st, where are they going to pull that money from, Alex?
Yeah, that's really important, and probably a good place to finish up on is I want people to understand that when they're trying to pull money out of these funds and their a lot of the super funds are invested in real estate investment trusts, but predominantly real estate, and because it's the safe house. Yeah, and it's all well and good to construct these things and buy it and say that this property is worth this much on paper, but it's not like a share or a Bitcoin where I can just sell it and that's the market rate. It's, well, hold on, I need $20 million. Who wants to buy $20 million of property? Or put another zero on that, Alex, or two. Yeah, exactly. So it's just no liquidity, and that's where we're having to see the Fed in America, and we already saw the Victorian government say, well, maybe we're going to buy $500 million worth of off-the-plan apartment. Like, it's just who knows who bails who out here. I know, and the big scary thing, the scary fact is that a lot of these super funds are actually lending money to the developers. So how are they going to be able to lend more money if they're having to dig into their liquidity or their assets, off-sell it to then lend against it, to lend against the development? And where's that going to end up? So it's a big revolving circle, and it works all the way down to the tradie who's got to get up and go to this construction site to earn the money to go back to where he needs to go and do his stuff. So the property market, residentially and commercial, Alex, we're in for a interesting time. Yeah, I mean, we kind of laugh and joke sometimes, and in the Wolf of Wall Street, he talks about you got to keep them on the wheel, and that's the problem. As soon as you actually have one person that tries to get their money out, then the house of cards can start to come down, and that's what central banks and governments around the world are trying to avoid right now. That's right, and I mean, and the way that the banks are lending money now,
it's like, how do we lend money to people in this pandemic? What can we do? What boxes do we have to check? How do we know we're going to get that money back? Are those industries going to be there? And that's why we're seeing that shift on the investor side of it as well.
Awesome. Well, I'll put all the links to follow Neil down below. For our members, we might even do a live Q&A in the group at one stage or something, Neil. But that's been really good. Any final thoughts for people at home?
Yeah, all I can say right now, just be prepared. Stay safe, but be prepared. Check go back, do your budgeting. If you are looking to borrow money, don't go out and bid at an auction and then go look to get finance. Yeah, go out and get the advice first. Have a look around. Find someone who's experienced in the industry. So I always talk about a team. Make sure you've got your legal team, you've got your finance team, and then you've got your property team, which is either your building inspectors and stuff, before you do anything now, more than ever. And if you've got a pre-approval, go get it double checked.
Awesome. Okay, well, hope you guys have enjoyed that. Something different. Let us know down in the comments below. And we'll have to do it again, Neil. Thanks.
No, thank you, Alex.
Cheers, guys.